Welcome back to the deep dive. Our mission today takes us right into the core arteries of American commerce. We're focusing on a giant, Union Pacific Corporation, ticker UNP.
Yeah.
And this isn't just about, trains and tracks. It's really about a company hitting peak efficiency and then immediately making this huge, almost historic bet, this $85 billion merger proposal.
Yeah, it's a massive move. And our source material is pretty current. Goes right up through those October 2025 earnings reports.
So really up to date.
Exactly. And it gives us this snapshot of UNP right at, well, a real inflection point. You see the strong foundation, the financial strength, those efficiency gains they've locked in. But then right alongside that, there's this colossal, once-in-a-generation kind of regulatory risk they're taking on with this merger.
Right.
So we really need to dig into the metrics, what makes them so strong, and then weigh that against the sheer uncertainty of this whole transaction.
Absolutely. And because this is a proper financial investigation, we should set the stage like our main source does. It starts with their mission statement.
Okay, it goes. Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Union Pacific, ticker UNP.
Risk defined, reward assessed. So you, listening in, you're joining us to figure out which side of that scale weighs more for Union Pacific right now. And to really grasp the reward potential, we absolutely have to start with the basics, the performance, because honestly, without this recent operational strength, this merger, it just wouldn't even be on the table.
You got it. When you look at railroads, efficiency is everything. And unlike a lot of industries looking at operating margins, railroads focus on the operating ratio, the OR.
Okay, let's break that down quickly for everyone. The OR, it's basically the flip side of margin, right? It shows how much it costs to earn a dollar of revenue.
Exactly.
So an OR of 65 means you spent 65 cents to make a buck. An OR of 58, you spent 58 cents. So lower is better, much better.
Precisely. And Union Pacific, especially under CEO Jim Van Uren, they've been pushing that number down hard. Our latest figures, Q3 2025, they actually got their operating ratio to less than 60.0%.
Wow.
59.9% to be specific, which is, a huge psychological barrier to cross.
And a competitive one. That sub-60 number, that feels big. But what does it really tell us about where they stand in the industry right now? Hitting it once is great, but can they keep it there?
Well, it signals they're leading the pack. For all of 2024, their OR was 58.7%.
Yeah.
Already best in class in the U.S.
Okay.
So this Q3 result, it confirms it wasn't just a blip. It feels structural. And what's really fascinating is how they did it in Q3. Get this. Operating income went up 6%.
Okay.
While operating costs only rose 1%.
So that gap.
Yeah.
That 5% difference.
That's pure efficiency gain dropping straight to the bottom line.
Yeah.
Pure shareholder value. They're growing revenue without really growing the cost to run the network. It's impressive leverage.
That is remarkable control. So let's look at what's driving that. Freight revenue.
Yeah.
If we strip out fuel surcharges, which can be volatile, that still climbed 4% to a record $5.3 billion in Q3.
Yep, record territory.
So revenue's up, but costs, especially labor costs, those are tough to control, right? Particularly with inflation being so sticky. How are they managing that piece?
Yeah, and this is where Vena's operational discipline really shines through. They actually lowered total compensation costs by 1% in Q3 25.
Lowered them with wage inflation. How?
Well, they did it despite that industry-wide wage pressure. The sources point directly to pretty aggressive productivity gains.
Wait a second. If wages are going up, how do you cut total compensation costs by 1%? It must mean fewer people, right?
That's exactly it. They cut headcount by 4%, a significant reduction.
Okay, so if you're cutting 4% of your workforce, but you're maintaining or even improving these really high service levels, what's the risk there? Safety, morale, labor relations down the road.
That's the million-dollar question, isn't it? It's the core trade-off in this precision schedule railroading, the PSR model Vena's known for.
Right.
Management's view is, look, we're getting 6% higher workforce productivity. The people left, plus the technology, are making the system way more efficient. And they argue a smoother, more predictable network is actually inherently safer.
Yeah.
Less congestion, fewer issues.
Right.
But you're right, you absolutely have to watch the labor angle, especially when you're about to try and merge with another huge company that requires integration, maybe more cuts. It's tricky.
Okay, so that's structural efficiency. It builds a really strong financial base, which you absolutely need if you're thinking about an $85 billion acquisition. Let's talk balance sheet. We always look for that moat in these deep dives.
And their balance sheet isn't just strong, it's exceptionally well managed for a company this size.
Yeah.
In Q3 25, they got their total debt down below $32 billion.
Okay.
And that resulted in a net leverage ratio of 2.6x.
2.6 times. For our listeners, why is that considered like rock solid in the rail sector?
Well, in these really capital-heavy businesses, infrastructure like rail, analysts often feel comfortable with leverage around 3.0x, maybe even 3.5x.
Right.
So dropping down to 2.6x gives them a really significant cushion. It's actually the lowest they've reported in at least a year. And that's what really supports their A-range investment-grade credit rating.
So they have financial flexibility.
Tons of it. It lets them approach the big debt piece of this potential NSC merger from a position of strength, not weakness. They've got room to breathe.
Okay, let's switch gears to valuation. If UNP is the most efficient, financially strongest railroad,
Yeah.
you kind of expect it to trade at a premium, right? But their blended PE ratio as of Q3 2025 was 19.4x.
Yeah, and that 19.4x number is really interesting because it's actually below its 10-year average.
Oh, really?
Yeah, 10-year average is 21.2x. So historically, the market has actually valued UNP higher, even before factoring in any potential upside from this massive merger.
So what's that telling us? The market's applying a discount.
It suggests exactly that. And that discount is almost certainly tied to the huge regulatory risk, the integration risk.
Yeah.
Basically, the uncertainty around the Norfolk Southern deal.
So the market's saying, yeah, we love the efficiency, but we're going to wait and see if this giant bet pays off or if it just distracts you.
Pretty much. Analysts are actually forecasting like 8-9% annual EPS growth for 26 and 27 just based on UNP's standalone performance, just keeping that OR momentum going, which kind of reinforces the idea that the stock might be undervalued, even if the merger falls through, just based on how tightly they're running the ship now.
And speaking of rewarding shareholders, UNP has always been a favorite for dividend growth, folks. We're looking at a 2.5% dividend yield as of Q3 of 25. And backed by, 18 or 19 straight years of raising the dividend annually.
Yeah, something like that. An impressive streak. Supported by a pretty conservative payout ratio, too, just over 40%.
That consistency is huge. It's a cash-generating machine, this business. And they've historically given that cash back, not just dividends, but big share buyback programs, too.
Right. But, and this is a really important signal, this is where you see the strategic shift because of the merger plan. Management actually halted share buybacks in Q3 25.
Stop buying back stock.
Completely stopped.
That speaks volumes, doesn't it? They're hoarding cash. They stopped a program that boosts EPS. They'd bought back something like 44% of their shares since 2006, specifically to get ready for the cost and the debt of the NSC deal.
It shows exactly where their priorities are now. The dividend commitment. That stays. That's crucial for stability.
Sure.
But every other spare dollar is being lined up for this acquisition. It tells you management sees a higher long-term return in pulling off this merger than just continuing to buy back their own stock, even at that slightly discounted 19.4x PE.
Okay, so the foundation looks incredibly solid. But growth has always been tied to the broader economy, hasn't it? Railroads are cyclical. If they can't control the macro picture and nobody can, where does the structural growth come from? How do they break out of just following GDP?
That's exactly what they're trying to address with this internal development pipeline. This is how UNP tries to insulate itself from just riding the economic waves.
Yeah.
They're actively managing somewhere close to 400 industrial development projects across their network.
400? That's a lot.
It is. And this isn't just, sitting back and managing property they own. They're aggressively working with customers to build new factories, new warehouses, new facilities right onto their rail lines.
So they're essentially creating their own future demand.
Precisely. They're manufacturing future carloads.
And the scale of that, you mentioned the pipeline has potential revenue attached.
Yeah, the active construction pipeline that's over 200 projects currently being built has the potential, they estimate, to generate about $1.5 billion in future annual revenue opportunities.
Wow, $1.5 billion. That's a pretty significant buffer, isn't it? Especially if the merger doesn't happen or if the economy slows down.
It's a substantial safety net. It provides these sort of secular growth streams that should kick in over the next, say, 5 to 7 years, helps smooth out the bumps. And you could already see this strategy working in certain high-demand areas right now.
Okay, let's dig into those specific growth markets then. Where are they seeing the real outperformance today?
Well, two areas really jump out from the reports. First is petrochemicals and plastics. They saw volume growth over 10% in Q3 25 alone.
Over 10%. Why such strong growth there?
It's tied directly to all the production expansion happening along their huge Gulf Coast franchise.
Right, the Gulf Coast. Why is that such a hotbed right now?
It's largely about the U.S. advantage in cheap natural gas liquids, NGLs, feedstock advantage. So you've got these massive new plants being built to turn those cheap NGLs into plastics, which then get shipped all over the world.
And UNP is positioned to capture that traffic.
Exactly. They've poured over $430 million in capital into that region alone in the last 5 years to support this. They're set up to haul the finished product for export and also for, the domestic market as more manufacturing maybe comes back on shore.
Okay, petrochemicals is one. What's the other big growth area?
The other one is grain and renewable fuels. Volumes there are up over 30% just since 2021.
30%, that's huge growth.
Massive. And it's not just good harvests. It's directly linked to policy shifts and demand growth for renewable fuels like ethanol and biodiesel.
Ah, the biofuel angle.
Right. UNP serves something like 20-plus new or expanded grain facilities that were basically built to feed that growing biofuel production. So they're turning, government policy and consumer trends into actual freight volume.
So they've got these growing revenue streams. How do they protect those revenues and make sure they contribute to that all-important operating ratio? Let's talk pricing power.
Their strategy here is all about discipline. They explicitly aim for pricing that is accretive to the operating ratio.
Accretive to the OR, meaning...
Meaning they're committed to raising prices faster than their underlying non-fuel costs are rising. So they're targeting, for instance, capturing inflation, excluding fuel of about 3.5% a year between 2025 and 2027.
So if their costs go up 3%, they want prices up 3.5%.
Stuff like that. That's the goal.
Yeah.
It's this direct link between pricing and operations that makes it powerful. Every time they renew a contract, the goal is for that new contract to actively help lower the overall OR.
Got it. Okay, now let's shift to the tech side, the technological moat. Because railroading today, it feels less like just steel wheels on steel rails and more about, data and algorithms.
Absolutely. They are investing heavily in AI and real-time data to manage this incredibly complex network. The main tool they talk about is adaptive transportation planning, or ATP.
ATP, what does that actually do day to day?
Think of it like a super smart virtual train master that's always optimizing. It's AI-driven. It figures out the best routing for trains. It builds the actual train plans of which cars go where, the schedules, the sequence, and it constantly adjusts those plans based on what's happening right now. Weather delays, track congestion, crew availability. It's crunching all that data in real time across the entire network to maximize how they use their trains and tracks.
And then there's the terminal command center. That sounds like where the plans meet reality.
Exactly. The terminal command center is sort of the execution arm on the ground. It gives local managers real-time dashboards and tools to make decisions, keep the terminals running smoothly, and stick to the plan that the AI, the ATP, generated.
And this push towards AI and automation, it's not just theoretical, right? Management expects actual savings.
Oh, yeah. They're projecting that these innovations will deliver over $100 million in real, quantifiable productivity gains over the next 3 years.
That's significant. And we can actually see the results of this tech in hard numbers, can't we? Like train length.
We absolutely can. And it's probably the most striking metric they've reported recently. All this planning, all this optimization, it led to UNP hitting an all-time record average train length of 9,700 feet back in Q2 25.
9,700 feet. That's nearly 2 miles long.
It's enormous.
You definitely don't want to get stuck at a crossing waiting for that one. But operationally, why is that specific metric so important?
It's the ultimate indicator of asset utilization.
Yeah.
If you can basically combine the freight from, say, 3 shorter trains onto one really long one.
Fewer crews, fewer engines.
Exactly. Fewer crews, fewer locomotives needed, and you take up less space on the track for less time, which frees up capacity across the whole network. It drives density, and density drives down that operating ratio.
And crucially, they achieve this record length without apparently hurting their service quality.
That's the key claim. They reported 98% on-time service for their intermodal business, that's containers, and an incredible, almost perfect 100% for manifest operations in Q3 25.
100% for manifest. That's the really complex stuff, right? Individual rail cars going everywhere.
Yeah, manifest is notoriously tricky. Different car types, different destinations, lots of switching. Hitting 100% reliability there, if they can sustain it, gives them a huge advantage over competitors.
How so?
Because in an industry that's often struggled with predictability, being able to promise that level of reliability means you can potentially charge a premium price. It backs up their pricing strategy we talked about. They're not just selling space, they're selling efficiency and dependability. And, as Jim Vivana himself pointed out, having that kind of service quality locked down is absolutely essential before you even attempt something as complex as integrating another railroad.
Which brings us right to it. The elephant in the rail yard. The proposed takeover of Norfolk Southern NSC. This isn't just another deal, it's potentially redrawing the entire U.S. freight map.
It really is. This is UNP's massive, ambitious play to create America's first truly transcontinental railroad.
Yeah.
We're talking an $85 billion stock and cash offer for NSC.
$85 billion.
Yeah. The goal is to stitch together the entire country, basically, over 50,000 route miles across 43 states. The source is actually, quote, CEO Jim Vivana framing this as like finally fulfilling the original vision from 160 years ago, Lincoln's push for transcontinental rail. It's got that kind of historic framing.
Let's look at the deal structure. NSC shareholders aren't just getting a check, right? They're getting a big piece of UNP stock, too.
That's key. They're set to get 1.0 UNP common share plus $88.82 in cash for each NSC share they own.
Okay.
So the structure works out to be about 72% stock and 28% cash. By making it mostly stock, UNP is signaling, hey, we believe in the value we're creating together, and we want you, the NSC shareholders, to share in that upside. It ties everyone to the success of the combined company, which would be valued pro forma at over $250 billion.
Now, a deal this big, affecting basically every major port, every industrial region, politics has to play a role. Obviously, the Surface Transportation Board, the STB, they're the official regulators. But have there been any signals, any political nods mentioned in our sources?
There have been, and it's something UNP is definitely highlighting. President Trump apparently made comments supporting the merger, saying something like, "It sounds good to me." And UNP management is absolutely running with that.
Yeah.
They're positioning the deal as an absolute win for the U.S., arguing it's crucial for national competitiveness, it'll create jobs, fix supply chains, the whole narrative. In a sector this sensitive, having even perceived political backing like that is a significant talking point they're using with regulators and the public.
Okay, let's get to the reward part of the equation, the financial justification. For an $85 billion price tag, the expected synergies, the value creation, it has to be huge.
Oh, it is. The headline number they're projecting is $2.75 billion in annualized synergies within 5 years after the deal closes.
$2.75 billion a year.
Per year. That synergy number is really the core financial argument for why this deal makes sense on paper.
And how does that break down? Is it mostly cost-cutting, or is it about generating new revenue?
Good question. The split is about $1.75 billion coming from revenue synergies, and that's mostly pinned on converting freight from trucks to rail.
Okay, truck-to-rail conversion. We'll come back to that. What's the rest?
The other $1.2 billion is projected from cost efficiencies. Basically, taking UNP's more efficient operating model, their tech, their focus on that sub-60 OR, and applying it to the Norfolk Southern network, which historically hasn't been quite as efficient.
Okay, I got to jump in there with a bit of skepticism, as a good financial investigator should. $1.75 billion in revenue synergy, mostly from stealing business from trucks. That sounds potentially optimistic, maybe designed to sound good to the regulators who worry about rail competition. Is that truck-to-rail shift really achievable on that scale?
It's definitely ambitious, no question.
Yeah.
But management's argument hinges on the operational benefit. The big selling point is the single-line service.
Right. No handoffs.
Exactly.
Yeah.
By eliminating the need to stop and switch freight between two different railroads, usually in congested places like Chicago, they believe they can offer transit times and, crucially, reliability that really starts to challenge long-haul trucking on price and speed. They argue that if a shipper sees they can reliably save, say, a day or two in transit time compared to the highway,
Yeah.
well, suddenly rail looks a lot more attractive, even for goods that traditionally move by truck, because rail used to be too slow or unpredictable due to those interchange delays. They think this seamless network opens up whole new markets.
And if they pull that off, it translates directly into better numbers for shareholders down the road.
That's the plan. The deal is expected to start boosting adjusted EPS in the second full year after closing, eventually reaching high single-digit EPS accretion. But the number that really tells the story about long-term financial health is the projected leap in free cash flow, FCF.
Okay, let's put that FCF jump into context. What kind of numbers are we talking about?
Well, they project the combined company's pro forma free cash flow could go from around $7 billion based on their combined 2024 results up to a massive $12 billion by the year 2029.
$7 billion to $12 billion FCF.
Yeah. And remember, FCF is the cash left over after everything's paid, operating costs, capital investments to maintain the railroad. It's the real discretionary cash.
So that $12 billion FCF, that's the fuel for.
Future dividend hikes, paying down the acquisition debt aggressively, continued investment in technology, everything. That FCF growth story is probably the single most compelling financial metric they're pitching.
Okay, beyond the finance, let's focus on the nuts and bolts for the customer. Why should, say, a farmer in Iowa or a plastics company down on the Gulf Coast actually care if these two railroads merge? What's in it for them?
It comes down to getting rid of those interchange delays. That is the single biggest headache in North American rail freight today.
The handoff problem.
Right. When a rail car moves from UNP's network in the west to NSC's network in the east, or vice versa, it has to stop. Often for a full day, sometimes 2 days, just sitting in a yard like Chicago, waiting to get sorted and put on a different train run by the other railroad. It creates huge bottlenecks and makes shipping times unpredictable.
So the merger creates this single, seamless network.
Which eliminates those interchange delays, potentially cutting shipping times by a crucial 24 to 48 hours. And that affects about 1 million carloads every year.
1 to 2 days faster. That's significant for supply chains.
It's potentially transformative. Lower inventory costs for shippers, much more reliable delivery dates, and this faster, more reliable single-line service is what they position as being far more truck competitive. That's a key part of their argument to regulators, too. We'll take trucks off the highway, which helps with congestion and emissions.
Okay, lastly on the merger benefits, the competitive landscape. This deal, if it happens, it fundamentally blows up the current structure in the East, right? Where it's basically NSC and CSX as the two big players.
Absolutely. It shatters that Eastern duopoly. A combined UNP-NSC creates this massive transcontinental giant that puts the remaining players, especially BNSF, that's Berkshire Hathaway's railroad, and CSX, at a serious competitive disadvantage.
How so? BNSF is huge in the West, too.
True, but BNSF dominates the West alongside UNP. They don't have a unified partner in the East that allows them to offer that seamless, coast-to-coast, single-line service.
Ah, so UNT-NSC could offer customers a door-to-door service that BNSF simply can't match on its own.
Exactly. The pressure on BNSF in particular would be immense. They might be forced into making their own major move, another merger, maybe a huge partnership deal, just to stay competitive against this new Union Pacific behemoth.
So this could trigger more consolidation.
It almost certainly would.
Right.
Rivals like Canadian National and CSX, they already started announcing enhanced cooperation agreements right after the UNP-NSC news broke. That shows you how seriously they're taking this potential shift.
Yeah.
If this merger goes through, it could very well kick off a cascade of reactions across the entire industry.
Okay, the potential rewards are clear. Huge scale. Those $2.75 billion in synergies, the power to really go head-to-head with trucks. But now we have to circle back to that mission, defining the risk. Even with UNP's amazing operational strength, what are the big structural or cyclical risks hanging over them?
Well, the number one risk, acknowledged by everyone, is just cyclical weakness. UNP is a proxy for the economy. It's super sensitive to industrial production, commodity prices, overall economic health.
Right.
If industrial growth stays weak, like it has been really since 2021, that hurts their volumes. It puts pressure on those great margins. A serious recession. That could significantly ding earnings, hit the stock price, compress that PE multiple.
And even if the economy holds up, there are always risks just inherent in running a railroad, right?
Definitely. You've got ongoing operational hazards, things like the potential for labor strikes. It's always a possibility in U.S. rail. And, really importantly here, the inherited liabilities.
From Norfolk Southern.
Exactly. When or if they acquire NSC, they also acquire the financial baggage. That includes the environmental claims, the long-term remediation costs related to that highly publicized Eastern Ohio derailment. That's a serious, potentially very expensive long-tail risk that has to be factored in.
Okay, but the absolute biggest hurdle, the elephant in the room for this specific deal, has to be the regulatory process. Merging two Class I railroads hasn't been done successfully since the 90s, right? And the rules are tougher now.
It is the ultimate regulatory gauntlet, no doubt about it. They're aiming to close the deal by early 2027. That means about a 22-month review process by the Surface Transportation Board, the STB.
22 months. That's almost 2 years of uncertainty.
It's an eternity in the financial markets. Creates a huge overhang. And the STB today is operating under much stricter mandates about preserving competition, ensuring service quality doesn't suffer.
So the risk is?
The risk is that the STB just says no, blocks the deal entirely, or maybe more likely, they approve it, but only with really tough conditions, forcing them to sell off certain lines, grant access to competitors, conditions that could significantly eat into those projected $2.75 billion synergies and erode the deal's value. That regulatory uncertainty is the single biggest risk factor right now.
And let's say they clear that hurdle. The deal gets approved. The risk doesn't just disappear then, does it? It morphs into the integration challenge.
Absolutely. Now you've got the massive, incredibly complex task of actually merging these two giant railroads. Different computer systems, different union contracts, different corporate cultures. It's a recipe for problems, if not managed perfectly.
Right.
There's a real risk that this integration challenge distracts management, especially CEO Jim Vena, from just run the core railroad efficiently. It could lead to cost overruns, delays, getting systems aligned, and maybe even temporary but painful service disruptions that tick off customers.
And hurt the synergy capture.
Exactly. Management says they've learned from past messy rail mergers, but the potential for fumbling the integration and not realizing those full $2.75 billion in savings, it's definitely there.
Okay, so let's try and synthesize all this. We've done the investigation. We have this company, UNP, that's firing on all cylinders operationally, best-in-class efficiency.
Rock solid balance sheet, 2.6x leverage.
Great growth pipeline they're building themselves. But they're putting all that strength on the line for this transformative but incredibly risky merger. So what's the final takeaway for our listeners? How do you weigh that risk versus reward?
I think the picture is pretty clear, but it's kind of two-sided. Structurally, Union Pacific is incredibly strong. That leading OR, the balance sheet, the internal growth projects, that foundation means the company likely has good value, even if this merger fails.
Okay, so a strong standalone case.
A very strong standalone case. However, the really big upside potential that jumped to $12 billion in free cash flow, the potential for the stock multiple to expand significantly, that's almost entirely dependent on pulling off this merger, getting through the regulatory maze, integrating NSC successfully.
So high risk, high reward.
Exactly. It's a massive bet on the future shape of the industry.
And what's management telling investors? What's their official line on growth with or without the deal?
They're staying very bullish, actually. They're confident they can deliver high single to low double-digit EPS growth over the next few years, just based on their existing operations.
Based on that sub-60 OR, the tech, the pricing power?
Right. That standalone operational machine is strong. They see the merger as this huge potential accelerator, obviously, but they believe the engine is built to run well regardless.
Okay. Well, that was definitely a deep dive into Union Pacific's current strength and this massive transcontinental ambition they've got. We've picked apart the operational machine Vena built, looked at the tech edge, and really defined the stakes involved in this Norfolk Southern deal.
Yeah, it's a potentially industry-defining moment, driven by some really compelling economics, eliminating those interchange delays, grabbing share from trucks. But like we said, defining the risks, that regulatory reaction over the next couple of years, that's the wild card. That's the controlling factor.
Which leads us perfectly into the final thought for you, our listener, to chew on based on everything we reviewed. If, and it's still a big if, but if Union Pacific pulls this off, if they create the first truly seamless coast-to-coast U.S. railroad, it changes the competitive game overnight. So what's the inevitable reaction going to be from their biggest competitor, BNSF, Berkshire Hathaway's railroad? How fast will BNSF feel forced to make its own massive move to create a similar single-line service? Does this trigger the final round of major rail consolidation?
That pressure on BNSF to respond somehow, whether it's a merger or a huge alliance, it would be unprecedented. We're already seeing some smaller moves like we mentioned with CN and CSX. The competitive need for that single-line offering might just force everyone's hand. It'll be fascinating to watch if UNP's bet fundamentally reshapes the entire industry map.
We will definitely keep watching. Thank you for joining us for this financial investigation. We have defined the risk and we've assessed the reward.
Risk defined. Portfolio protected.